Hi. With all this money, debt inflows already starting to come in and expected to increase over the next year and possibly more. The numbers, about 14 billion has come in the last 12 months. And the expectation are that with Indian bonds going into the JP Morgan index, about another 20 to 30 billion will likely come in over the next 12 months. Plus, there are other bond indices that are welcoming Indian bonds, which is great because that means money is coming in. However, having said that, one of the things is that as there are a larger volume of professional international fund managers in the Indian market, the volatility of flows and hence of the rupee is likely to increase. Professional fund managers simply respond to, they don't look at on a very micro basis, they look at macro issues and they move money around. So that is likely to be a strong force in affecting volatility of the rupee. Now, over the last year or so, RBI has really made it almost an article of faith to keep rupee volatility as close to zero as they could. But as the pressure increases, I'm sure they will have to weigh the pros and cons of that, right? So if the volatility is going to increase, now there's no certainty that A, that will happen, and B, that if the volatility increases, the rupee will necessarily strengthen. Although with the inflows coming in, that's certainly a good possibility. It's perhaps time for exporters to start reducing risk on open exposures. Now, over the last year, with premiums so low, many exporters have been doing nothing because they're accustomed to 4-5% premium. With 1%, 1.5%, people don't want to sell because the rupee always weakens, right? To my mind, now is and let me say one more thing, that if in fact, instead of not hedging, they had been simply hedging over the last year, they'd have made about 50-60 paisa on average per dollar. Despite the fact that the rupee did not move and the premiums were so low, 6 months forward was better on average than spot at maturity by 50 paisa. So A, you've already lost some money. B, if the volatility increases and the rupee gets stronger under the inflows, or at various times gets stronger under the inflows, you're likely to lose even more. So to my mind, it's important that exporters start increasing the hedge, using forwards, perhaps if the volatility does show signs of increasing, use some structured options. But I also feel that they shouldn't go too far forward. After all, November is a very strong nodal point, the US elections. And anything can happen then, or even before then, given all the troubles in the Middle East. Many of those issues, particularly Trump and an escalation in the Middle East, could create a global risk-off crisis, which would then push the rupee lower, and exporters who hedged would be losing. But I do think it makes sense to not hedge because you're expecting some trauma, right? So I feel we need to be cautious, as always, slowly increase the hedge out to, let's say, November, and perhaps use some structured products further out. Importers, of course, on the other hand, have had an easy ride. Despite the low premiums, they've been gaining if they didn't do anything. Generally, I don't think it's a good idea to do nothing. But I think it would make sense for importers to watch carefully and as we get closer to November, start hedging using structured products.